Right, so today we're going to take a deep dive into Xponential Fitness.
Okay.
They just had their earnings call for the fourth quarter and full year 2024.
So
A lot to unpack. There are a lot of interesting stuff going on with them.
Yeah, for sure.
We're going to start with a kind of a high-level overview of the results, and then we'll dive into some of the
get into
the more interesting color commentary and strategic direction.
Absolutely.
So kicking things off, North American system-wide sales.
Okay.
Increased by 21% year over year to $465 million in Q4 2024.
Wow.
And for the full year, they reached $1.7 billion,
Okay.
which was a 23% increase.
Healthy.
So
yeah, very healthy.
pretty solid growth there.
Yeah, that's great. And it's really impressive to see that kind of growth.
Yeah.
In the North American market specifically.
Yeah.
I think it speaks to the demand for these boutique fitness experiences. That Xponential is offering across their various brands, So
Yeah.
I think that's definitely a positive sign.
And it's something that I've noticed too, just anecdotally, going around.
Yeah.
I feel like there's just more and more of these studios popping up everywhere.
Yeah, absolutely. I mean, I think people are really prioritizing their health and fitness.
Right.
And they're willing to spend money on these, kind of specialized experiences.
Totally. And speaking of spending money, the North America quarterly run rate, AUV,
Okay.
so average unit volume, saw a 9% increase to $668,000.
Oh, wow.
So that's basically saying that, on average, each studio is generating more revenue than they were.
That's really good to see, because it means that the existing studios are becoming more efficient at generating revenue.
Right.
So not only are they opening new studios,
Right.
but the existing ones are also performing better.
Yeah, absolutely. And then, on the membership front, things are looking pretty good there too. Total membership grew by 15% year over year, reaching 813,000 members at the end of the fourth quarter.
So they're growing their customer base as well.
Exactly. Yeah. So you've got, strong growth in terms of system-wide sales.
Yeah.
You've got average unit volume going up. You've got memberships going up. And then in terms of like their footprint, their, physical locations, they sold 400 franchise licenses.
Wow.
And opened 464 gross new studios globally in 2024.
Okay.
And in Q4 alone, 120 gross new studios opened.
Okay.
83 in North America, 37 internationally.
Okay.
And 56 licenses were sold.
So they're still expanding quite aggressively.
Yeah, absolutely.
And it's interesting to see that they're expanding both domestically and internationally.
Right.
Which, I think is a good strategy for growth.
Yeah, and what's interesting to me is that the number of gross new studios opening is higher than the number of licenses sold. So that suggests that they've got a backlog of licenses.
Yeah, it seemed like they're really focused on executing on those licenses.
Yeah.
Maybe they had a big push to sell licenses in the past, and now they're really trying to get those studios open.
Yeah, could be.
Or it could be that they're seeing more opportunities to open studios in existing markets.
Right.
Where they already have a presence.
Makes sense.
So yeah, it's definitely something to kind of keep an eye on.
For sure.
And see how that trend continues.
Yeah. Now here's where things get a little bit, more nuanced.
Okay.
They did report 65 global studio closures.
Okay.
In Q4 and 2025 for the full year.
Okay.
So that represents about 7% of their global open studios.
Okay.
Which is higher than the 3 to 5% that they had previously indicated.
Okay.
And notably, the majority of these closures were attributed to Stress Lab, Cycle Bar, and Yoga 6.
Okay.
So for somebody who's looking at this and trying to assess the health of their portfolio, what does that tell you?
Well, I think it raises some questions about the health of those particular brands.
Right.
Why are those studios closing at a higher rate than the others?
Yeah.
Is it something specific to those brands, or is it something more systemic within Xponential?
Yeah.
Maybe their franchise support isn't as strong for those brands.
Right.
Or maybe the market demand for those types of fitness experiences isn't as high.
Yeah, and I mean, I've noticed that too.
Yeah.
Anecdotally, I feel like I see a lot of Club Pilates.
Yeah, for sure.
And Pure Barre and some of those other brands.
Uh-huh.
but I haven't really seen as much of the cycle bar or the stress lab or some of those others. So
Right.
it's interesting.
Yeah, I think it'll be interesting to see how they address this.
Yeah.
In the coming quarters and years.
For sure.
Do they double down on those brands and try to turn them around, or do they maybe divest some of them?
Yeah.
And focus on the ones that are performing better.
Absolutely.
Oh.
All right, so moving on to the pure financials.
Okay.
Consolidated revenue for Q4 2024 was $83.2 million,
Okay.
which was a 7% decrease year over year.
Okay.
However, for the full year, revenue actually saw a slight increase of 1% to $320.3 million.
So it sounds like they had a bit of a tough fourth quarter.
Yeah.
But overall, the year was still positive.
Yeah. I mean, they still grew a little bit, but yeah, Q4 was definitely a bit of a slowdown there.
Right.
But interestingly, their adjusted EBITDA for the fourth quarter was $30.8 million,
Okay.
which was a 13% increase year over year.
Okay.
And for the full year, it reached $116.2 million,
Okay.
a solid 16% increase.
So their profitability is improving.
Exactly.
Even though revenue
That's kind of
it was a little bit
it's interesting.
soft in the fourth quarter.
Yeah, the juxtaposition there.
Yeah, exactly.
And what could be some reasons for that? Why would their revenue be declining while their profitability is increasing?
Well, I think there's a couple of possibilities.
Okay.
One could be that they're shifting their focus away from company-owned studios and more towards franchising.
Okay.
So when they franchise a studio, they don't recognize all of the revenue.
Right.
They just recognize the franchise fees.
Right.
So that could be one reason why revenue is declining.
Okay.
Another possibility could be that they're seeing some margin compression in their equipment and merchandise sales.
Okay.
Maybe they're having to discount those products more.
Right.
To move them.
Right.
So that could also be impacting revenue.
Yeah, that makes sense.
But despite that, their profitability is still improving.
Yeah.
Which suggests that they're doing a good job of managing their costs.
Right.
And really focusing on the bottom line.
Absolutely. And then, another thing to point out is that they did restate their 2023 financial statements and corrected what they believe are immaterial errors in their 2022 and 2024 financials.
Okay.
So these adjustments primarily related to things like accrued inventory, 401k compliance, purchase accounting, and vendor rebates.
So basically some accounting adjustments?
Yeah, some accounting cleanup.
Okay.
So, for somebody who's looking at this company and trying to assess, the trustworthiness of their financials, what do you think about that?
Well, I think it's definitely something to be aware of.
Yeah.
It's not uncommon for companies to have to make accounting adjustments.
Right.
But it is something that you want to look into and make sure that it's not a sign of anything more serious.
Right.
In this case, they're saying that the errors were immaterial.
Right.
So that's a good sign.
Yeah.
But it's still something that you want to, keep an eye on and just make sure that they're being transparent about their accounting.
For sure. And then finally, in our kind of results snapshot, they did miss their own projections.
Okay.
For gross new studio openings and adjusted EBITDA for the full year 2024.
Okay.
So they opened 464 studios versus their expectation of 500.
Okay.
And their adjusted EBITDA came in at $116.2 million.
Okay.
Falling short of their $122 million target.
So they miss on both growth and profitability.
Yeah.
Okay.
So, what's the takeaway there for you?
Well, I think it shows that they're facing some challenges.
Yeah.
They're not hitting their own targets.
Right.
Which suggests that maybe their growth is slowing down.
Yeah.
Or that they're having some trouble controlling their costs.
Right.
So it's definitely something to watch closely.
Yeah, absolutely. All right. So having kind of digested the numbers there,
right.
Let's dive a little bit deeper into the strategic direction.
Okay.
So CEO Mark King emphasized building a strong senior management team.
Okay.
And laid out 5 core strategic pillars for the company.
Okay.
And this seems to be a big focus for him.
Yeah, it sounds like he's really trying to set the company up for success in the long term.
Yeah.
By bringing in a strong leadership team and really focusing on these key strategic areas.
Yeah. And what do you think about that? I mean, is that a good sign?
I think so.
Yeah.
It's always a good sign when a company is bringing in new talent.
Right.
Especially at the senior level.
Right.
It shows that they're they're willing to make changes,
Yeah.
and that they're committed to growth.
Yeah.
And I think the fact that they've identified these 5 strategic pillars
Right.
is also a good sign.
Yeah.
It shows that they have a clear vision for the future,
Right.
and that they're taking a disciplined approach to achieving their goals.
Yeah. And they've already made some significant moves in terms of personnel.
Okay.
They brought on a new president of North America,
Okay.
a COO, a chief development officer, and a CTO.
Wow.
So they've really, beefed up their leadership team.
Yeah, they've brought in some heavy hitters.
Yeah.
Which is, again, it's a good sign. It
Right.
shows that they're serious about making changes.
Right.
And that they're willing to invest in the people that they need
Yeah.
to execute their strategy.
And in addition to that, they did a comprehensive internal review.
Okay.
And they identified some areas where they need to improve
Okay.
in terms of their structure, their capabilities, and their processes.
So they're doing some soul searching.
Yeah, exactly.
Okay.
Which is, again, it's a good sign that they're willing to take a hard look at themselves
Right.
and see where they can improve.
Yeah, I think it's really important for companies to do that.
Yeah.
To regularly assess their strengths and weaknesses,
Right.
and to make changes as needed.
Absolutely. All right. So let's talk about some of the specific things that they're doing to kind of address these areas for improvement.
Yeah.
So one thing that they're doing is they're creating field operations teams
Okay.
that will be physically present in North American studios
Okay.
to provide direct support to franchisees.
So they're putting boots on the ground.
Exactly.
Yeah. Yeah.
So, what do you think about that?
Oh, I think it's a smart move.
Yeah.
It shows that they're committed to supporting their franchisees.
Right.
Which is really important for the success of a franchise model.
Right.
Franchisees are the lifeblood of a franchise business.
Yep.
So it's important to make sure that they're happy and successful.
Yeah, absolutely. And then another thing that they're doing
Yeah.
is they're consolidating all franchise development activities
Okay.
under a single leadership structure.
Okay.
And they're moving away from relying on a broker network for franchise license sales,
Okay.
bringing that function in-house.
So they're streamlining their operations.
Exactly.
Yeah.
Yeah. So, what's the thinking there?
Well, I think they're trying to gain more control over the process.
Yeah.
By bringing it in-house, they can set the standards. They can make sure that the franchisees that they're bringing on
Right.
are a good fit for the brand.
Right.
And they can also control the pace of growth.
Yeah.
They don't want to grow too quickly,
Right.
because that can lead to problems.
Right.
So I think they're just trying to be more strategic about their growth.
Yeah, that makes sense.
And really make sure that they're doing it in a sustainable way.
Yeah, and I think it's interesting that they're moving away from the broker network
Yeah.
because, that was a way for them to grow quickly.
Right.
But it also maybe led to some quality control issues.
Right.
So by bringing it in-house, they can really focus on,
Yeah.
finding the right franchisees.
Right.
And making sure that they're successful.
Okay.
And then another thing that they're doing is they're looking at the physical studios themselves.
Okay.
And they're reevaluating layouts to maximize productivity and allow for greater customization
Okay.
based on local market needs.
So they're trying to optimize the studio experience.
Exactly.
Yeah. Okay.
And then they're also creating a new COO role,
Okay.
specifically overseeing learning and education,
Okay.
with the goal of boosting member retention.
So they're really focused on the member experience.
Yeah.
Okay.
So for, somebody who might be a member of one of these studios
Yeah.
or an investor who's focused on customer loyalty,
Right.
what's the significance of that?
Well, I think it shows that they're really trying to create a great experience for their members.
Right.
They want people to come back.
Right.
And they want people to be happy with their experience.
Yeah.
And I think that's really important for the long-term success of the business.
Yeah, absolutely. And then finally, on the strategic front,
Yeah.
their new CTO is tasked with enhancing their enterprise applications, data platforms, and analytics capabilities
Okay.
with a clear ambition to transform Xponential into a truly data-centric organization.
So they're embracing the power of data.
Exactly. Yeah.
Okay.
And I think that's really important in today's world.
Yeah, absolutely. I mean, data is everything these days.
Yeah.
companies that can effectively collect and analyze data
Right.
have a huge advantage.
Yeah.
They can use it to make better decisions. They can use it to personalize the customer experience.
Right.
They can use it to improve their operations.
Yeah.
So I think it's a really smart move by Xponential.
Yeah, absolutely. All right, so
Yeah.
let's shift gears a little bit and talk about their international ambitions.
Okay.
So Xponential has set a goal of having as many studios operating internationally as they do domestically.
Wow.
So that's a pretty ambitious goal.
Yeah, it is.
And they're planning to do this by prioritizing the expansion of Club Pilates.
Okay. And then selectively introducing other brands in markets where Club Pilates has gained a strong foothold.
So they're going to use Club Pilates as their spearhead.
Exactly.
Okay.
And they're also planning to establish on-the-ground leadership in key regions,
Okay.
starting with London in Europe and a presence in Asia.
So they're taking a very hands-on approach.
Yeah.
Okay.
So for, somebody who's looking at this company and thinking about their growth potential,
Yeah.
what do you think about this international push?
Well, I think it's a huge opportunity.
Yeah.
The fitness market is growing rapidly globally.
Right.
And Xponential is well positioned to capitalize on that growth.
Yeah.
They have a strong brand portfolio.
Right.
They have a proven franchise model.
Right.
And they have the experience and the expertise to expand internationally.
Yeah, absolutely. And I think it's interesting that they're leading with Club Pilates.
Yeah.
Because that's their strongest brand.
And it's the one that has the most global appeal.
I think so.
So it makes sense to use that as their entry point.
Yeah. And then once they've established a presence
Right.
with Club Pilates, they can start to introduce some of their other brands.
Right.
Maybe Pure Barre or Stretch Lab.
Yeah.
And really start to build out their portfolio in those markets.
Right.
So yeah, I think it's a really smart strategy.
Yeah, absolutely. All right, so let's talk about the EBITDA miss and the restatement of financials.
Okay.
So as we discussed earlier, management is attributing these issues to legacy operational challenges.
Okay.
That arose from scaling rapidly without a fully mature organizational structure.
Some growing pains.
Yeah, exactly.
Okay.
And they're saying that 2025 is going to be a year of foundation building
Okay.
to allow for re-accelerated growth in subsequent years.
So they're taking a step back
Yeah,
to build a stronger foundation.
exactly.
And they're also conducting a thorough review of their brand portfolio
Okay.
to optimize capital allocation.
So they're going to be looking at all their brands
Yeah,
and deciding which ones to invest in.
exactly.
Yeah.
So for somebody who's trying to understand their current posture,
Yeah.
what's the key message here?
Well, I think the key message is that they're focused on profitability.
Yeah.
They're not just chasing growth for growth's sake.
Right.
They want to make sure that they're growing in a profitable way.
Right.
And they're also willing to make tough decisions.
Yeah.
About their brand portfolio.
Right.
If they have brands that are underperforming,
Right.
they're not afraid to divest them.
Right.
So I think it's a very disciplined approach.
Yeah, absolutely. All right. So let's dive into some of the brand level performance.
Okay.
So in 2024, the strongest license sales came from Club Pilates,
Good.
Lindora, and BFT.
Okay.
And the brands with the most gross openings were Club Pilates.
Stretch Lab and BFT.
Okay.
And notably, their core scaled brands, which are Club Pilates,
Okay.
XPL US, Pure Barre Stretch Lab, and Yoga 6, represent 94% of North American studios
Wow.
and 95% of system-wide sales.
So those are the brands that are really driving the business.
Exactly.
Yeah.
Yeah. So
Okay.
What does that tell you?
Well, it tells me that they have a very strong core group of brands.
Yeah.
Those 5 brands are really the foundation of the business.
Right.
And they're the ones that are generating the most revenue.
Right.
And the most profit.
Right.
So I think it's important for them to continue to invest in those brands.
Yeah.
And to make sure that they're staying ahead of the competition.
Right.
But it's also important for them to keep an eye on their other brands.
Right.
And to make sure that they're not falling behind.
Yeah, and speaking of a brand that's maybe falling behind a little bit, Stretch Lab.
Okay.
So their AUV decreased by 8% year over year to 550,000.
Okay.
And same store sales were negative 5%.
So they're struggling a bit.
Yeah.
Okay.
And management has indicated that they're doing a comprehensive review of Stretch Lab
Okay.
to try to address these issues.
So they're taking it seriously?
Yeah, they are.
Okay.
So, what do you make of Stretch Lab's situation?
Well, I think it's a concern.
Yeah.
They're a relatively new brand.
Right.
So they're still in the early stages of growth.
Right.
But the fact that they're already seeing declining AUVs
Right.
and negative same-store sales
Right.
is not a good sign.
Right.
So I think they need to figure out what's going on.
Yeah.
And make some changes.
Right.
Maybe they need to tweak their pricing or their
Right.
marketing or
Right.
their operations.
Right.
But they need to do something
Yeah.
to turn things around.
Absolutely. All right.
Yeah.
So moving on to same-store sales across the rest of the portfolio. The picture is generally more stable,
Okay.
with most brands showing mid to high single-digit growth.
Okay.
Club Pilates led the pack with a 12% increase.
Yeah.
Yoga 6 and Pure Barre
Mm-hmm.
also showed positive same-store sales,
Okay.
while Cycle Bar,
Okay.
similar to Stretch Lab, experienced negative same-store sales.
Okay.
And interestingly, Lindora's AUV in Q4 was a very strong 984,000.
Wow.
So, what insights can we glean from this broader same-store sales data?
Well, I think it shows that they have a good mix of brands.
Yeah.
They have some brands that are growing very strongly, like
Yeah.
Club Pilates.
Right.
They have some brands that are growing more modestly,
Right.
like Yoga 6 and Pure Barre.
Right.
And then they have some brands that are struggling, like
Right.
Stretch Lab and Cycle Bar.
Right.
So I think it's important for them to continue to monitor the performance of all their brands.
Yep.
And to make adjustments as needed.
Right.
But overall, I think it's a pretty healthy portfolio.
Yeah, absolutely. All right. So
Yeah.
as we touched on earlier, their elevated studio closure rate in 2024
Uh-huh.
was primarily driven by underperforming
Okay.
Stress Lab, Cycle Bar, and Yoga 6 locations.
Okay.
And the company is taking a more proactive approach
Okay.
to managing underperforming studios
Okay.
to ensure a healthier overall franchise system.
So they're not afraid to close studios
Yeah.
if they're not performing.
Exactly.
Okay.
And they also noted that a significant portion of previously sold franchise licenses in North America
Okay.
are now considerably behind schedule and essentially inactive.
So there's a backlog of studios that haven't opened yet?
Exactly.
Yeah. Okay.
So what's the significance of this information?
Well, I think it shows that they're being more disciplined about their growth.
Yeah.
In the past they may have been too quick to sell licenses.
Right.
Without really making sure that the franchisees were ready to open studios.
Right.
So now they're taking a more cautious approach.
Yeah.
And they're making sure that the franchisees have the resources and the support that they need
Right.
to be successful.
Yeah. And I think that's a good sign.
Yeah.
It shows that they're learning from their mistakes.
Right.
And they're making changes to improve their operations.
Yeah, absolutely. All right. So
Yeah.
turning to their financial health.
Okay.
Their cash reserves decreased to $32.7 million.
Okay.
Net cash generated from operating activities was $11.7 million,
That's okay.
which included a notable $24.5 million from lease settlements.
Okay.
And their total long-term debt stands at $352.4 million.
Okay.
They are currently in the process of amending their credit agreement,
Okay.
and they're exploring options for more cost-effective capital with a longer-term aspiration of a whole business securitization.
Okay.
So what should we take away from this snapshot of their financials?
Well, I think that the key takeaway is that they're in a strong financial position.
Okay.
They have a lot of cash on hand.
They're generating positive cash flow from operations,
Right.
and they have a manageable amount of debt.
Okay.
So I think they're well positioned to continue to grow their business.
Yeah, and I think that the whole business securitization is an interesting concept. That's something that we've seen
Right.
other companies in this space do.
Yeah.
And it's basically a way for them to unlock the value
Right.
of their franchise system.
Right.
And use that to raise capital.
Right.
So it'll be interesting to see if they're able to pull that off.
Yeah, for sure.
All right, so looking ahead to 2025.
Okay.
They anticipate North America's system-wide sales to grow by around 13%.